Hey, Ren, I was thinking, do you own any of the massive companies in the US?
Nah, mate, none of them.
Yeah. Why is that?
Too expensive. I mean, Berkshire Hathaway goes for like $290,000 a share. Amazon is like $1,500 for one share. Hell, I can't even afford Netflix at $300 a share.
Yeah, well, instead of waiting around for a pay rise, there's no need for that anymore because our friends over at Stake, they've solved this problem for you.
Really? Tell me more.
So Stake is the simplest way to trade US shares. It's a new Australian company that's just started up, and they give you access to over 3,000 stocks and ETFs over in the US, and they offer you $0 brokerage. You can also buy partial shares, meaning, Ren, that you can finally buy $100 worth of Amazon if you really want to. And you know what the best part is?
What's the best part?
Now we've teamed up with Stake over here at Equity Mates. That's you and me, Ren.
Yeah.
And we're giving our listeners the ability to sign up with Stake and get $25 in their account to get them started. So if they head to equitymates.com/stake, STAKE, sign up and fund their account, Stake's going to swing them $25 into their trading account to get them on their way. So that's free brokerage, the ability to buy partial shares, so you don't have to spend $1,500 on an Amazon share. You can buy $100 worth if you really wanted to, and $25 to get you going. Mate, you're almost halfway there to a Berkshire Hathaway.
Berkshire Hathaway. Mate, with that free $25, I could get 0.01% of a Berkshire share for free.
I mean, it's a win-win situation, really.
You know what? I reckon if I held that 0.01% of a Berkshire share for like 80 years, I'd be set for life. I'd retire in luxury.
Well, get started.
Yeah, I'm going to right now.
equitymates.com/stake.
Stake, STAKE.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you, my man?
I'm very good, Bryce. How are you?
Good. It's been a good week. Back on air, so it's always exciting.
Yeah.
Talking to you.
Yeah, that's it. Were we ever off air?
Good point.
Yeah, very big week for the investing community, I guess.
Yes, absolutely.
A lot going on and a lot to look forward to, I guess.
Well, you've promised me that you've got some news headlines that you're going to be able to whip out in 1 minute or less.
Yeah. So I'll rip through some of them. The first one is it's Berkshire Hathaway weekend this weekend. So we're recording on Saturday, the 5th of May. By the time our listeners are listening to this, the weekend would have passed. But Warren Buffett's about to do a 6-hour-long Q&A session, so check out the results of that.
Epic.
The second one, Elon Musk had a very interesting conference call where he called analysts boring, not cool, and boneheaded. Definitely worth reading a bit more about that. Walmart purchased Flipkart, so they are buying 73% of it for $14.3 billion.
Oh, the deal was done.
Deal was done. Interestingly, Alphabet, so Google's parent company, is chipping in $3 billion of that $14 billion amount. So it's a Walmart and Google joint venture, I guess. And looking at Flipkart's existing shareholders, Microsoft owns shares, and so does eBay. So it's a bit of a all-star lineup taking on
Amazon will be
in
spewing.
India. Yeah, now ripping through it, Snap had a terrible report and shares fell 25%. So just more bad news for Snapchat.
No surprises there.
Apple announced a $100 billion share buyback on top of a $210 billion share buyback. So they're buying back over $300 billion worth of their shares, which is almost a third of their market cap, which is a lot. And last but not least, the US sent a delegation to China to try and resolve some of this trade war stuff. They've come back empty-handed, so expect more escalations over the coming weeks.
Boom.
A lot happening.
Right, you killed that.
Yeah, who says I waffle?
Let's crack into the episode, Ren. So this week I sent you a tweet that I came across in the Twitter sphere, and you being a Twitter shareholder, stoked to see that I'm using Twitter, I hope.
Yeah.
One of the users, yeah.
The first point of call for news these days, Twitter.
Yes.
So,
And so this tweet that I'll read out in a second sparked a bit of conversation between you and I, and we were both rather taken back by what the result of this tweet was. So I think what I'll do is I'll read the tweet and we'll go into a bit of a discussion about it. But I'd like you to particularly discuss the 2 and 20 because that's your little baby. So anyway, so this episode is going to be all to do with fees, and there's a lot of fees out there in the investing world that are sometimes more hidden than not. And this is one of our Buffett is always saying the best way to improve your returns is to avoid paying fees to fund managers. He's very anti-fund managers, which we've discussed in previous episodes. So this tweet came through and said, if you've invested $1,000 with Warren Buffett in 1965, that would currently be worth $4.3 million. However, if Berkshire had been a hedge fund charging 2 and 20, that $4.3 million would have accrued $300,000 to the investor, with a stunning $4 million going to the fund manager. So that's a pretty massive difference. You're going to have $300,000 at the end of the day in your back pocket if you were to go through a traditional hedge fund sort of a fee structure, which is the 2 and 20, or if you had gone through Warren Buffett, Berkshire, and where he doesn't charge that sort of fee structure and does all his reinvestments and that sort of stuff, you would have $4.3 million in the back pocket. So, Ren, before we go into the fees, let's sort of unpack this a bit. What are your thoughts on this? You were pretty taken away.
Yeah, I was really surprised. And, I mean, if you turn $1,000 investment into $300,000, you're not going to be disappointed. But
no.
Realizing that you left $4 million on the table just through fees is pretty crazy. So we should explain what this 2 and 20 is. So that's the standard hedge fund fee structure. And what that is 2% of the total amount invested every year, and then 20% of any profits or any gains. And so that's the way hedge funds make their money, and that is not what Warren Buffett does. Warren Buffett just has invested his own funds along with his investors' funds in Berkshire Hathaway. So in essence, he doesn't charge fees, and you can just see the crazy way that fees take away from your results. Literally, $4 million of $4.3 million gain would have been taken by your investment manager.
It's ridiculous. And it would be really hard to see that over an extended period of time, because unless someone puts it in a lump sum at the end, like 2% doesn't sound like an awful lot, and that's where people get sucked in. Oh, it's only 2%. But the compound of that over 50 years, or whatever it was, 1965, over 53 years, or whatever it may be.
It was when the blog post was originally written, it was 45 years.
45 years. Yeah. There you go. So, I mean, that compound effect is, and it's what Buffett always talks about, pardon me, is clearly massive. So, yeah, fees essentially stop your money from growing. And as a beginner, I think the better understanding you have of the impact of fees at an early stage, the better it is for your investing outcomes. Because, over a lifetime, fees can certainly be the difference between early retirement and not. So what we'll do is we'll take a look at what type of investment fees are out there and the obvious ones and then the less obvious ones and how they relate to sort of different investing products. And then we'll go into a few ways that you can avoid paying fees. So I guess, Ren, I'll start with one, and the most obvious fee is a transaction fee, right?
Yeah, definitely.
So you've got commission and brokerage, and we've discussed this a lot. They're obviously the fees that you pay to do the transaction, to buy the stock, and those fees vary anywhere from, well, now $0, with the stake, for example, which we'll talk about a bit later in how to avoid paying fees. But usually the brokerage fee is a flat fee, depending on your investing amount, and can vary anywhere from $8 upwards of 20. And then if you start investing larger amount, it usually becomes a percentage of the amount that you're investing. You have anything to add to that, Ren?
No, I think you've summed that up quite nicely. So that's the main type of fee there. The way that you enter into a trade, and unless you're with one of these new products like stake, you're paying a fee to engage in that trade.
What else? What other fees are out there that we need to look out for?
So I think the main ones, to my mind, are when you get someone else to manage your money. There are a lot of fees there that they have to be advertised, but sometimes you don't realize the implications of them. So you might have some more to add, but the main ones that I have are there's generally an entry fee. So when you originally put your money with a fund manager or a hedge fund, whoever it is, there's a fee to enter into that. And then any additional contributions you make, there will sometimes be a contribution fee. And then there is an ongoing sort of management fee. Now that can be similar to what we talked about before with the 2 and 20, or it can sometimes just be a percentage of the profits, or sometimes it can just be a percentage of the money under management. But it's really important that you're aware what the fees are, because, as we said before, you could be walking away with 300 grand, but leaving $4 million on the table. So
I had the investment management fees, obviously, and an expense ratio, which is essentially, we'll talk about it with the ETF, but it's, say, if the expense ratio is 0.9%, it means that for every 1,000 invested, $9 of that go towards the operating expenses of that management. And then you might have an annual account fee and those sorts of things. So there are a lot of fees out there, but I just wanted to make it clear for those that might be new to the show. Most of these fees, as you said, Ren, occur when you are doing off-market transactions. So occur when you're giving your money to a fund manager and he or she then go and look after it off the ASX. In terms of fees, if you're buying stocks on the ASX, then the main one that you need to be looking for is the transaction fee, which is your brokerage. However, if you were to be buying into, say, ETFs, then you need to be aware that those ETFs, exchange traded fund companies, also carry fees in the way that they manage their investments. So whilst it's not going to be a direct cost to you out of your bank account, in terms of when a brokerage comes out of the sort of funds that you're paying, they take it into account when they are giving a return on your investment. That makes sense, doesn't it, Ren?
Yeah. In a nutshell, if someone else is looking after your money, whether it's through an ETF or whether it's through a private fund, there will be fees involved. People aren't going to manage your money for free. The last ones that I just want to touch on quickly are super funds. So This is something that obviously everyone is exposed to, but people probably don't think a lot about. But similar to how fees can erode your investment performance, fees can erode your super funds performance. And there's a lot more fees that might be in the fine print in your super fund. So it's really important that you are looking at what the expense ratio is sometimes what it's called, or you're looking at, what the administration fees are and the contribution fees, and you're getting a total idea of how much you're paying to be in that super fund.
Yeah, that's a good point, and I want to touch on that because super is particularly something that you should pay interest to, I guess, pay a lot of interest in, because especially at this age where we're getting paid super, or if you're in a full-time role or whatever it may be, if you're accruing super, having a look now and figuring out what is the best option in terms of fees will make a massive difference over the long term. And especially with super, it's a set and forget. So you don't want to be setting and forgetting and then looking at your account summary in 10 or 20 years and having on the table a lot of money taken out in fees that you could have avoided many years before purely by just taking the time to have a look. So they make it very clear what the fees are, and it's very easy to do comparisons. I'm sure finder.com.au, who we spoke to last week, will probably even have a superannuation comparison on their site. So definitely worth having a look at. So that's a good call out, Ren. So I guess the next part is, how do we avoid paying these fees? Like, obviously, people need to make their money, and so that's why they're putting these fees in, and it's now becoming easier to avoid some of the more obvious fees. But sort of what's out there that can help investors minimize the impact of these fees?
So I think the big one is index funds. So they're generally ETFs, and they have revolutionized the investment industry, I guess. They're passive funds, so rather than a group of hedge fund managers or someone managing your money actively trading, they will just track, the 200 biggest stocks in Australia or the 500 biggest stocks in America or whatever it is, and their fees are far lower.
So how do I get access to it in an index fund?
So they're ETFs that we always talk about. You just trade them like you would a normal stock. But even within that, so that's the best way to avoid fees. But even within that, there are different fee structures for very similar products. There's a couple of examples that we can talk about. If you're looking at buying the biggest 500 companies in America, there are two options that sort of illustrate the difference in fees. One is the ASX code IVV, and the second is the ASX code SPY. And they are both the S&P 500, so they hold exactly the same shares. But for IVV, their expense ratio is 0.04%, and for SPY, their expense ratio is 0.09%. So
0.04.
Yeah, so they both seem
Wow.
like a tiny number, but for exactly the same product, you're paying double the fees for one than the other. So it's
That
just
is so cheap.
It is so cheap, but
40 cents for $1,000.
yeah, but if you hold it long enough, it can make a difference. And similarly, there's a new product being launched by BetaShares, an Australian company, A200, which is the 200 biggest Australian shares, and they have a expense ratio or management cost of 0.07%, whereas the previous cheapest ASX 200 ETF had a expense ratio of 0.14%. So again, if you don't do your research, you might be paying double the fees. You might be paying 0.14% rather than 0.07%, which again doesn't sound like a lot, but it adds up over time. And when you're paying for exactly the same product, why pay more than you need to? Do you have any other good ways to avoid paying fees or minimize paying fees?
Yeah, absolutely. So for brokerage, for example, there's a number of platforms out there that are actively ensuring that they can provide the cheapest rate on brokerage as possible, particularly the online brokerage platforms such as IG. They were one of the first to market with much lower brokerage than the banks. So they were paying that you could pay $8 with them every time you did a trade relative to the big banks who were sitting around $20. So that was a good way to reduce your transaction fees. And now with the likes of Stake in Australia and then Robinhood on their way, they offer free brokerage. So that's a massive bonus when it comes to trading stocks. You don't have to pay every time you want to make a trade. However, the fees to watch for those sort of companies are, if you're trading in the US, for example, with Stake, you need to transfer your money from Australian dollars to US dollars. And of course, there's going to be a transaction fee in that, but I'm sure it's not going to be anywhere near as harmful to your end balance than if you were paying brokerage every time you did a trade. So
yeah, the good thing about that is that you only pay it when you're transferring your money. It doesn't affect the rate of compounding while it stays in US dollars. And exactly. I guess that should be the golden rule. Like, you want to minimize the fees that minimize the compounding effect of your money.
That's the key to this whole thing, really. That's the message. Is at the end of the day, yeah, you don't want to be the guy with $4 million in managers.
No.
Back pocket and $300K in your own.
There's this book, and its title is Where Are the Customers' Yachts? And it was written in like the 40s by someone who had lost all their money in the 1929 crash. And it's basically, asking the question, someone went to New York and saw all these money managers with their, fancy yachts. And they asked the question, well, where are all the customers' yachts? And the fact of the matter is, customers aren't the ones getting rich a lot of the time. It's the managers that are, collecting all the fees and buying the fancy yachts. So you just got to keep that in mind. And, obviously managers do a great job and have made a lot of people a lot of money, but it's something that you just have to be mindful of. And it's probably a case of diversifying properly. So fees aren't all bad. There's a reason that you pay fees, but you probably don't want all your money tied up in high fee paying investment.
Absolutely. And you don't owe anything to anyone. So just because you start with one broker platform and there's nothing stopping you going to the other, you should do it. At the end of the day, they're all offering essentially the same products. You can still buy the same stocks. You can still trade the same way you would like to. But if you can just avoid paying these sorts of fees, then it's going to go a long way
down the track, especially if you're trading in small amounts. I mean, if you're going to throw down $500 and pay $20 in brokerage on that trade, I mean, as a percentage, that fee is very high. So you want to be avoiding doing those things while you can. And now we've got the technology and the companies and the businesses that are allowing us to do it. So yeah, that's probably a wrap, Ren. I think so. We've covered everything pretty briefly to do with fees.
Yeah, well, if you're interested in reading a little bit more about fees, we'll include our blog post entitled Have You Paid Your Stupid Tax in Equity Mates Thought Starters coming out on Monday. Yeah. I actually realised that this episode will only be released on Tuesday, so
coming out yesterday.
Yeah, we'll release Have You Paid Your Stupid Tax. We'll include that in the next Thought Starters from when you're listening to this episode. So if you want to read some more about fees and how you can avoid them, check out that blog post.
And for those of you that are new to the show, Thought Starters is our weekly email that comes out on a Monday where we give you 5 interesting articles that will help provoke some thought. Anything to do with investing, business, all that sort of stuff. We will send it out to you every Monday. You can jump on to our website, equitymates.com, and sign up. We promise we don't spam you. It's 1 email a week. But there's some great content in there that will get you through the week. And yeah, definitely encourage you to guys to sign up. But that's it, Ren. Looking forward to...
And we should say we don't charge fees to sign up. So
no,
save your money.
We are fee-free.
Yeah. We won't affect your rate of compound.
All right, sounds good, Ren. We'll talk next week.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.